Gold just did something unthinkable. In less than 72 hours, it dropped below $5,000 per ounce. Yes, the metal that spent months climbing to historic highs just got crushed. Right now, as you watch this video, gold is trading at around $4,149 to $4,161 per ounce. That's a drop of more than 3% in a single session. And millions of investors are asking the same brutal question: is this the last chance to buy, or is more pain coming? I'm going to tell you everything the financial media is not telling you. Stay until the end, because what I reveal in the last 2 minutes will change how you see this correction completely. Let's be honest about what happened. Gold didn't fall by accident. 3 forces hit at the same time, and the combination was like a punch in the stomach for precious metals. First, the US dollar surged. When the dollar strengthens, gold gets more expensive for international buyers, and demand drops fast. Second, the latest US Producer Price Index, the PPI, came in hotter than expected. That means inflation at the production level is still elevated. And here's the irony. In the short term, strong inflation data actually hurts gold because it signals the Federal Reserve may keep rates higher for longer. Third, the Fed confirmed a pause on rate cuts. No cuts expected in the next meeting. Higher rates mean higher opportunity cost for holding gold, which pays no interest. So what do you get? A strong dollar, sticky inflation, and a stubborn Fed, all colliding at once. Result: gold falls from above $5,000 to $4,149 in days. Now here's what almost nobody is telling you. This is not a structural crash. This is a technical correction inside a powerful bull market. And the difference between those two things could make or break your 2026 portfolio. Step 1. Look at the bigger picture. Gold started 2025 below $2,700 per ounce. It crossed $3,000, then $4,000, then $5,000. Even after this drop, gold is still up massively over 12 months. A 3% session after a historic run is normal market behavior. It is not a collapse. Step 2, check who is still buying. Central banks around the world, China, Poland, Turkey, India, have not stopped purchasing gold. In fact, according to the World Gold Council's latest data, central bank purchases in early 2026 continued at near record pace. These institutions don't panic sell on a bad PPI number, they accumulate on dips. Ask yourself, who do you want to behave like? Step 3, identify your entry zone. The $4,800 to $4,900 range is now being watched by major institutional analysts as a potential support zone. If you have been waiting to enter, this volatility window could be exactly what you were looking for. But do not invest money you cannot afford to leave invested for 12 to 24 months. Gold rewards patience, not desperation. Step 4, choose your instrument wisely. Physical gold coins or bars, ideal for long-term protection and inflation hedging. Gold ETFs like iShares, Gold Trust, or Invesco. Physical gold, ideal for liquidity and ease of access. Digital gold platforms, convenient, but check that storage is allocated and audited. Avoid leveraged gold products completely if you are a beginner. The volatility right now will destroy leveraged positions. Step 5, storage and security. If you buy physical gold, use a certified vault service or a bank safety deposit box. Do not keep large amounts at home without proper security measures, and always keep your purchase receipts. You will need them for tax purposes when you sell. Now let's talk about where this is heading. JP Morgan's commodities team raised their 2026 gold price target earlier this year, citing continued central bank demand and geopolitical uncertainty as primary drivers. Goldman Sachs has maintained a bullish long-term outlook, pointing to de-dollarization trends and structural demand from emerging market central banks. The Bank of America forecast suggests gold could retest and potentially surpass $5,000 again in mid to late 2026 if the Fed pivots toward rate cuts. According to the World Gold Council, global gold demand in 2025 hit its highest level since records began, driven by both investment demand and jewelry consumption in Asia. Here is the key question: what changes the bull thesis? Only 2 things would fundamentally reverse gold's direction. 1, the Fed aggressively cuts rates and the economy booms with zero inflation. 2, geopolitical tensions resolve completely and global debt levels stabilize. Neither of those scenarios is happening in 2026. Global debt is at record levels. Geopolitical tensions in multiple regions remain elevated. The Fed is in a pause, not a tightening cycle. The structural case for gold is intact. This dip is noise inside a larger signal. Listen closely. This is the part most YouTube channels skip. While retail investors panic sell gold on days like today, central banks and large institutions are doing the opposite. China's People's Bank reported continued gold reserve increases in recent months. The European Central Bank has publicly acknowledged gold's role in reserve diversification. Poland's central bank became one of the largest gold buyers in Europe over the past 2 years. These are not small investors reacting to a PPI print. These are trillion-dollar institutions making 10 to 20-year decisions. And they are all moving in the same direction: more gold. Here's the brutal truth that almost nobody tells beginners. The volatility you see on a single day is designed to shake weak hands out of their positions. When retail investors sell in fear, someone with more information and more patience is on the other side of that trade, buying. You're watching institutions accumulate gold at a discount. The question is, are you going to let fear make your decision, or are you going to think like the institutions? Let me give you a clear, practical framework for 2026. How much gold should you hold? Most financial planners suggest between 5% and 15% of your total investment portfolio in precious metals. For beginners, start at 5%. If you already hold gold and feel comfortable, up to 10% to 15% is reasonable, given the current macro environment. Do not put 50% or 80% of your savings into any single asset, including gold. Diversification is not weakness, it is protection. Physical versus ETF, which one? Physical gold is best for wealth preservation over the long term. It cannot be hacked, frozen, or go to zero. Gold ETFs are better for flexibility. You can buy and sell instantly and hold in a standard brokerage account. The ideal strategy? Hold a core position in physical gold for security. Use a smaller ETF position for tactical flexibility. The biggest mistakes beginners make right now. Mistake 1, buying all at once during a volatile moment. Instead, use a strategy called dollar cost averaging. Buy a fixed amount every 2 weeks or every month. This smooths out your entry price over time. Mistake 2, panicking during corrections. A 3% drop after a massive bull run is completely normal. Selling at the bottom locks in losses. Mistake 3, chasing gold mining stocks without understanding them. Mining stocks are more volatile than physical gold and carry company-specific risks. Do your homework before adding miners to your portfolio. Mistake 4, forgetting about storage and insurance costs. Factor these into your total return calculation when comparing physical gold to ETFs. If this video gave you real clarity on what is happening with gold right now, do me a favor, hit that subscribe button. This channel exists to give you honest, data-driven analysis on precious metals. No hype, no fake predictions, just real information for real investors. Leave a comment below with the words "informative video" if you found this useful. It helps this channel grow and tells me you want more content like this. And share this video with one person in your life who is confused about what is happening with gold right now. You might save them from making a very expensive mistake. Gold is not dead, the bull market is not over, but the next 30 to 60 days will separate the disciplined investors from the emotional ones. Which one are you going to be? I'll see you in the next video. Take care of your money, because nobody else will.